Parks Capital, where education plus investing equals success.
Hi everyone. Welcome to the Market Outlook for the second quarter of 2022. I am your portfolio manager, Rajiv Dixit. I hope you all had a good first quarter. When we last spoke in January, I left you with two primary market observations. First was the fact that the equity markets were moving in a sideways fashion, or resting as I called it at the time. The second was the case I made for the potential for equity markets moving higher in the future due to several conditions that warrants this move. Conditions like high levels of cash in money market funds, economic reopening trade just starting, etc. I would submit to you today that one of those observations no longer applies to the markets. Markets clearly are no longer moving in a sideways fashion. In fact, the trend has now broken down and moving lower. In our opinion, there are two major risks that our portfolios face in the near term. First, and still the most primary risk, is that of inflation. As you know, I have been raising concerns regarding the rising inflation since June of last year. This risk has now taken a new form of concern. While we're excited the Federal Reserve has started taking steps to control inflation in this country, the Russia-Ukraine crisis emergence has resulted in a sharp increase in the price of oil. Our concern is that the Federal Reserve's effort to reduce inflation will be counteracted with the rising price of oil. This could lead the Fed to overplay its hand of raising rates more aggressively, which could negatively impact the economy in the near term. We all know that the Fed is already playing the game of catch-up with the problem of inflation. Thus, it's more likely to overreact if their initial efforts of controlling this problem were to fail. While still small, the second risk also stems from the Russia-Ukraine crisis. It goes without saying that the human tragedy from this crisis is unsurmountable. We believe, though, that the financial damages to the market from the current state of this crisis are limited. The risk is, if this crisis was to last for a much longer time than currently anticipated, or worse, was to spill over into other parts of the European economy, the financial markets could react negatively to the geopolitical panic. Again, in our minds, the likelihood of this happening is still low at the present time. Now that I have outlined the risks to the portfolio, let me tell you about the actions we have taken to protect against these specific risks. As you know, we have maintained a position in gold since we first identified the risk of rising inflation. Last year, we also started to add exposure to oil and oil-related companies to strengthen our defense against this risk. In the past quarter, as the risk has increased, we have also increased our exposure to these and other commodities. We believe that this exposure will help us reduce the risk that the portfolio's equity positions would suffer in case inflation gets out of hand. It is important to note that our goal here is not to profit from the rise of inflation, but rather to hedge the overall portfolio's losses. Going forward, we will continue to monitor the inflation-related risk and adjust these positions wherever and whenever warranted. In order to protect against the second risk of geopolitical panic, we have gone back to the same tool we have used in the past, the US Treasury bonds. You have heard me say this before, time after time. When there is global geopolitical panic, money makes its way to the safest place on earth, which remains to be the US Treasury bond. With that in mind, last quarter, after recognizing this possible risk, we have started a 3% initial position in US Treasuries. Again, we continue to actively monitor this risk and will adjust this position if warranted. Lastly, since the primary goal of this strategy is to lose less than the market when markets go down, we have also raised our cash position by implementing a systematic selling program that sells off the most volatile ETF positions. We also believe that this cash will benefit us once the short-term downward trend is over. More on this a little later in our Outlook section. Right now, let's talk about something else. I have just outlined to you what we are doing to manage the risk in the portfolios in these turbulent times. There is also something you can do to reduce the risk to your long-term financial success. Let's think about this another way. What do you think is the biggest challenge to successful long-term investing? When asked, many would say, the game is rigged against the small guy. The markets are too volatile. Consistent lower returns is the risk, etc., etc. What I believe the biggest challenge to successful long-term investing is emotions. Right. Failing to control one's own emotions on a consistent basis is the biggest risk. Whether that is emotions of triumph and overconfidence in up markets, or emotions of fear and panic in down markets. I know that all of you are very savvy with this already. You must be. We have seen some of you go through 9/11, the 2008 financial crisis, the pandemic. We saw you go through these times without letting your emotions get the better of you. If you weren't good at this, honestly, you wouldn't be where you are today. But I think we all can use more sharpening of our ability to control our emotions when thinking of our investments. Recently, we came across this wonderful book that does a phenomenal job of explaining why emotions and human behavior are key to financial success. We were so impressed by this book that we believe every one of us should read it. As I speak, a copy of this book is being delivered to you either in person or by mail. Please read it at your leisure to sharpen your skills of what you already do very well. Manage your emotions in the realm of finance. Talking of emotions, I know that I started this outlook with a cautious tone. While I believe that caution is warranted at this time due to the outlined risk, I also believe that in the long term, the equity markets still have all the catalysts for a move higher into new highs. In fact, I view this near-term turbulence as an excellent opportunity to buy some companies at reasonable, and in some cases, discounted prices to strengthen our portfolio for the long term. This is the reason we believe the additional cash we raised in Q1 to protect our downside will come in handy to buy new opportunities in later quarters or whenever the dust settles. Rest assured, we continue to monitor the markets for value and for risk. I want to remind you again, the purpose of this update is not to predict the future. No one can do that. The purpose of this update is to inform you of what we are seeing and how we are preparing for it. Of course, if things were to change between now and the next update in 3 months, we would be reporting about those changes and how we adapted to them in the next update or during our next conversation. We cannot close this piece without highlighting one obvious fact. The above views of the market and the narration of the events is a general view. You know that every portfolio in Parx Capital is managed based on who you are. Thus, they all look a bit different based on your risk tolerance and your individual goals. Please keep that in mind. We're looking forward to talking with each of you in your quarterly reviews. Remember, education plus investing equals success.
Here at Parx Capital, we strongly believe that a successful investor is an educated investor. For this purpose, we've created our own YouTube channel. Education plus investing equals success.